Today, I'll share with you the best tips to increase your credit score for 2023. A few years ago, I realized the importance of building a strong credit score, especially if you want eventually to become a future owner. What often people realize is the impact that a good or a bad credit score can have on your overall life, but they don't know how easy it is to boost your credit score. It's why today I'll share with you some great tips that I have personally used to boost my credit score over 800 without making any kind of big sacrifices. But first, let's define what a credit score is. A credit score could be compared with a grade that you receive at school, but with the difference that instead of listening to a boring teacher, you are at the school of life. I don't know if you remember, but when we were younger, usually we thought that it would be the end of the world if we had a bad grade at school. However, through time, we realized that it wasn't that important, and at the end of the day, you had other chances to help you out to pass your year. However, for your credit score, it is quite harder than that. Since your credit score represents a certain ladder of your credit worthiness for different kind of individuals, and little mistakes can have big impact on your score. And this ladder can be represented by a number between 300 and 850. The lower your score is, the less chances you have to be successful when you're asking for credit. And it's why it is crucial for you to understand the main criteria that are impacting your FICO score. This FICO score is pretty much the same as the credit score, and it is illustrated by 5 multiple criteria, which are the payment history that is worth about 35% of your overall score, 30% is from the amounts owed, 15% is from the length of credit history, 10% for the credit mix, and 10% for the new credit. Now, let's see one by one what are those criteria and how you can optimize them. First, the one that has the most importance is the payment history. As the name is saying it, this criteria is about how well you can pay your credit. Indeed, the first and the most important things that lenders want to know about you when they want to lend you some money is to know if you've been able to pay all your different credit accounts in the past. If you're someone that tends to forget to pay its credit cards on time, well, it could be a great idea for you to find ways to be more consistent with your payments if you don't want your credit score to be highly affected by that. Personally, a great tip that I am applying to reduce the risk of forgetting to pay my credit card is that when I receive my credit statement each month, I will receive a notification on my cell phone which will tell me to go pay my credit card at that time. And it has a great advantage, which is to optimize my credit utilization ratio. This ratio can be found by dividing the balance by the credit limits for one card or for all your different cards. Generally, the lower your utilization is, the best it is for you. And a great rule of thumb to keep in mind is that when you surpass 30% of credit utilization, this usually hurts your credit score. It's why, personally, I'm aiming for a ratio of less than 10% of utilization on my different credit cards to maximize this ratio. Now, for your second most important criteria for your score, it is the amounts owed that actually worth about 30% of your overall FICO score. And once again, this is a pretty clear criteria as well that is showing the importance of a certain amount that you owe to a lender. However, even if you owe a certain high amount of money, it doesn't necessarily mean that you are a high-risk borrower. Once again, the credit utilization ratio will be super important for that criteria. In fact, banks tend to see with a bad eye that you are using a lot of your available credit. So as I told you earlier, make sure to keep your credit utilization percentage as low as possible. For example, once again, if you have a $5,000 credit card, you could aim for a 20% of credit utilization or less. This would mean that per month, you would have about $1,000 that you could use on your credit card. But on your side, if you think that this limit isn't enough high for you, well, you could ask your card issuer to increase your limits on your different cards. But be careful with that because it can rapidly become a double-edged knife. In fact, even if you increase your credit limits, it doesn't mean that you could also increase your spendings. Now, for the third criteria, it is about the length of your credit history that is worth about 15% of your FICO score. Basically, your score will count and will take in consideration how long has it been since you have opened all your different credit accounts. So how old is your newest and your oldest different accounts and what is the average of them? But it will also take in consideration how long it's been since you've used your different credit accounts. Obviously, the best to optimize your credit score is to have been able to open different credit accounts since a lot of time. So the longest, the better. A great gift that you could offer to your different kids is to offer them the possibility and to encourage them to open their first credit card as soon as they can. But also teach them how to be intelligent with it without overspending. However, keep in mind that in many different places, you're not allowed to open a credit card account if you're not 18 years old or more. Or sometimes you can be allowed to open a credit card before if you have an authorization from your parents. So as soon as your kids will reach 18 years old, you should encourage them to get their first credit card to start a great credit history, and eventually they will definitely appreciate this help, especially if they want to buy a future first house. Now the fourth criteria is to have a great credit mix that is worth about 10% of your overall score. Having multiple credit sources like having some retail accounts, a credit card, a car loan, or even a mortgage can greatly improve your credit score. But does it mean that you should apply to have all the different credit lines that you currently don't own? And the obvious answer to that is no. You should not apply all at once to get all those credit cards and those credit loans that you currently don't have, because all of those creditors could see those demands and those appliances as a sign of financial distress. And this leads us to the fifth and the last criteria, which is worth about 10%, which is the new credit. As I just told you, this criteria is implying that opening many different new accounts at the same time isn't the best idea for your credit score, because in fact this represents a massive risk, especially for the people that doesn't really have a long line of credit history. In fact, if you decided to open all of those accounts at the same time, it could obviously send a negative signal to the different creditors, but this would also massively decrease your average age of your credit accounts, which would obviously impact your credit history. However, this doesn't mean that you should never open a new credit account, because despite losing some credit score initially from opening those new accounts, well, if you decided, for example, to purchase a new credit card, this could eventually lead to a lower credit utilization, which would mean obviously to increase your credit score in the future. To summarize the good practices that you should adopt to boost your credit score, first it is to start having your first credit card as soon as possible to build a strong credit history. After, you must find the right credit limit to not surpass what should be your optimal level of credit utilization. Personally, I recommend you to have a 10 to 20% of credit utilization target. And if you don't currently own a credit card that has this possibility to offer you this low credit utilization, well, you might need to find ways to increase your credit limit or also to pay more often your credit cards. But make sure to not apply for too many credit accounts at the same time to not penalize you for the future. As magical as it could look, the credit cards and the different credit accounts are not free money and free gifts that are offered to you by your card issuer and by the banks, but it is money that you will eventually have to pay back, especially if you want to avoid the super high interest rate of those card issuers and those banks. However, if you want to find out how much money should you own and what should be your net worth depending on your age, well, check out the video that's gonna be right over here. And if you like personal finance, make sure to join the North family by subscribing to the channel for only $0.0, and I will see you soon. Peace!